All right, so I'd like to talk a little bit about being prepared for what's to come. Obviously, nobody knows exactly what's going to happen with the market. A lot of different arguments coming from both sides. Is the market going to crash? Are things going to sort of stabilize? Or will we continue to see an uptick in prices along with the uptick in interest rates? Certainly going to make for a very interesting future over the next 6 to 24 months. No question about that. But I think it all comes down to preparedness. Housing markets historically that get hit the hardest are often the ones that can rebound really quickly. So if you're ready for it, I think that there are a lot of ways that you could take advantage of that. Back in the Great Recession, we saw the coasts sort of get pummeled initially, right? And they were early in, they got hit the hardest. I remember back in Colorado, we even saw some of my properties were getting pounded very, very early. I mean, I saw a price dip on a $315,000 fourplex that I've mentioned on this channel before, drop all the way to a $135,000 value in just the first 6 months. I purchased it in November of 05, and by May of 06, that property lost, 180 some odd $1,000 worth of value. That is terrifying to think we could experience it again. And what I want to do going into this potential downturn that's different than that downturn is be as prepared as possible. So let's talk briefly, Michael, about the situational awareness and how to really come in and take advantage of the potential if there is a potential correction in certain areas, or even better yet, a crash to where we really see things on sale.
Yeah, no, and you hit the nail on the head, just being prepared, really. And that's what we always try to bring here on the channel is none of us know what's going to happen. There's data out there we can follow, but there's not going to be guarantees either way. We've been here on the channel saying that there's going to be a crash. I mean, do we think it's imminent? Is it not ever going to happen? No clue. We're going to find out ultimately, but being prepared for that is always going to be the key. And like you said, the coastal towns are always going to be hit the hardest. So if you're watching as an investor, and I can give you firsthand experience, those are going to be the places that I'm going to be looking at, because they're going to get hit the first, they're going to get hit the hardest, but they're going to ultimately rebound. They're going to be the first to rebound, and they're going to be the fastest to recover after that. So Flagler County, Palm Coast, it's in Florida. This would have been 2013. Moved down there to Florida to start Pink Houses of America with my partner Scott down there, and we came across Palm Coast. So we had done a lot of deals, or we're doing a lot of deals in and around Jacksonville, Florida. Palm Coast was one of those kind of just specific beach towns that was about 45 minutes away from us. But after doing some research, we saw that their home prices just got completely devastated after 08. So they were flying high, coastal town, tons of commerce, lots of new business coming in. And I mean, it came to a screeching halt. I mean, it was dead. I mean, just a ghost town at that point. So we went in there as investors, obviously, and we had cash and we were prepared. And, we're going to encourage you guys to go out there and do the same thing, because cash is king. When you've got it, you can take advantage of sales. And we're not on here to talk about whether or not there is going to be a crash or a correction or whatever you want to call it, but why not be prepared for it? We were prepared. This would have been 2013. So several years after the crash. So we didn't even have to come in right after it, but values were still really low. We were buying them at deep, deep, deep discounts. So we were making a lot of money that way, but kind of flip side of the coin, where there are a lot of sellers there, or potential sellers or homeowners that were underwater based on the new market value. So they were upside down. They couldn't sell their house. What we did is came in with an executive lease purchase, so kind of that Swiss Army knife approach. We're going to encourage anyone watching, if you are familiar with non-traditional real estate, this is going to be a really good time to come in and utilize some of those skills, because you might not have cash, or you might not be able to utilize your own credit as an investor to go out there and pick up these deals. But there are still ways to kind of capitalize on these market corrections, if you will. And that's what we did back then. So be aware of states like Florida, taking a look at the coastal towns of California, Nevada, Arizona. So here's some stats. 2008, 1 in 14 houses in Nevada went into foreclosure. Same year, Florida was 1 in 26. In Arizona, it was 1 in 30. And in California, it was 1 in 23 houses. So guys, there's no better way to predict the future than by looking at the past. And that's real data right there.
Yeah, and I'm happy you're getting into some of that. I'd actually like to come through some of these charts and actually analyze this together in a moment. But you brought up a great segue that I didn't expect to talk about on this call, which is the Pink Houses of America business model. If you aren't familiar with non-traditional types of real estate, Pink Houses happens to be one of the best out there in preparation for what is coming. And if you haven't checked that out yet, we'll throw some links in the description of the video so you can really see what that business model looks like. A phenomenal way to really skyrocket your side hustle income. We have tremendous number of people who have engaged with them over the years from this channel directly that have been extremely successful in that model, achieving even multiple hundreds of thousands of dollars worth of revenue, working 15, 20, 25 hours per week from home. And that is a way that without any of your own money or credit, you can actually get sellers to work with you and solve what we expect are going to be some pretty severe problems for a lot of people out there in the streets. So if you haven't checked it out, go ahead and email pink@vipfinancialeducation.com. Put conversation in the subject line. Make sure to include your first name, last name, and phone number in the body of the email so that you can actually receive a contact phone call. And P.S., they're not going to hard sell you or twist your arm. Michael, the owner of the company, obviously being here on the video, is always accountable to that type of a process. If you're not a good fit, then they're not going to get you talked into it. Now, I want to move into some of this data here. So we've got the pre-crisis peak per square foot, what that price tag was, and then the post-crisis trough per square foot was, along with the post-crisis peak and what that percentage increase actually looks like. And if you just start with the Modesto, California area, which was one of the areas that got hit the absolute hardest also, we see a 200 per square foot price tag. Back in 2007, 2008, that was at the peak of the pre-crisis price tags. And then post-crisis, where we saw the trough come in, the price per square foot dropped all the way down to $85 per square foot. We now see a current price per square foot peak after the crisis, the recession, of only $182 per square foot. So guess what? Regardless of these tremendous appreciation rates throughout the country, we still are not pre-recession numbers in Modesto, California. However, the recovery on that leads the list. We're seeing from $85 at the trough end of that post-crisis per square foot price tag being a 114%, increase to today's prices, or the peak prices of $182 per square foot. So timing the market in that case, I think it just represents that it really does to some extent matter when you buy. Going out and just willy-nilly purchasing at any time, and it's always a good time to buy mentality. If you didn't have a game plan on this property and this was a primary residence for you, and it wasn't a great investment property where it was an actual asset versus a liability, which those of us in the business that understand real estate are happy to admit that your own property is not an actual asset because you're not making money from it unless you're actually renting out rooms, or you've converted a portion of the property into a short-term rental, or you have an ADU on the back of your property. Without those exceptions involved, your primary residence is not an asset. That would have been a bad purchase for you at the top of the market there in 2007, 2008. If we kind of scroll down the list here, let's see if we can get into some other areas. Let's look at Reno, Nevada. We've got $193 per square foot pre-crisis peak, and that dropped all the way to $97 post-crisis trough, and then recovered all the way back up to $204 per square foot at the post-crisis peak today, which is 110% recovery. Very good. Just proves the point that if you're poised and ready to take action when we start to see certain corrections or even crashes in various geographical locations, that you could come out well ahead. We can look down here into Florida. We've got Cape Coral, we've got Fort Myers at $169. This is the pre-crisis peak per square foot. And then we've got the $82 post-crisis trough per square foot price tag. And the recovery on that jumped back up to the post-crisis peak of $154 per square foot for an 88% recovery. Very good as well. And we're seeing here in, say, Detroit, Michigan area, $123 pre-crisis per square foot price. This is the peak pricing, down to the $71 trough pricing of post-crisis, the lows. And then we've got the post-crisis peak price of $130 per square foot for an 81.8% increase. And then let's jump to Arizona. We've got Phoenix, the Mesa Scottsdale area, $159 pre-crisis peak pricing, down to the $81 low after the crisis, and then a recovery up to $147. Again, a perfect example of, in spite of some of the best real estate we've ever seen in our entire lives, still not a full recovery for those people who were unfortunate enough to get in at the peak pricing pre-crisis. This, to me, and offer your input here, Michael, indicates cause for pause, a good reason to be patient about your decision making when the writing is all over the wall. Mm-hmm. There's not a person out there that hasn't at some point admitted that the market has been wildly outrageous over the last few years. In some areas, prices have seemingly doubled from what they were 3 years ago. I purchased a property just over 3 years ago for $610,000 that now is granted only zestimated at 1.18 million value. So according to Zestimate, I'm looking at almost a near double price tag for that property. I'm curious to know what your thoughts are on this with respect to readiness and really getting your ducks in a row now so that you can take advantage when we start to see some of these corrections happen again.
Yeah, I mean, just those cities that you rattled off, it's not going to be coincidental that those exact same markets are going to be going through that same cycle. Real estate is very cyclical and it can be market specific. Now there's going to be one-offs, and I think if we dissected every relevant market in the United States, there would be some anomalies based on growth and decline that wouldn't necessarily hold true across the country. But for the most part, the places that historically get hit the hardest are going to get hit the hardest again. And historically, the ones that come back the fastest and the hardest are going to be coming back the fastest and the hardest again. So, look at that data exists out there. I love that map that we put out there, and just going through those cities like that. That's where I'm looking. I mean, I'm looking at that with my team, my analysts right now, and those are the places we're active. Those are the same places we were active back in 2012, 2013 also.
So one of the things that we've recommended recently on this channel, if you haven't done so already, is to explore the equity position that you currently have perceived in your properties today. And that would allow you the possibility of getting access to that capital and having that liquidity on the sidelines. Michael, thoughts about that outside of going into something a little less traditional like the pink houses model?
Yeah, I mean, utilizing debt weapons like a HELOC, I know that's one of your favorites, one of the favorites here on the channel right now. If you don't have, other access to liquidity, or you don't have borrowing power, that's a phenomenal way to go out there and kind of get your own war chest ready for it. Look, if you've got access to cash, there are going to be deals out there. Is it going to be blood on the streets? I don't know. I mean, we'll see what happens, but I know that there's going to be some panic selling. For one reason or another, we never, pretend to know what people's motivation is for selling, and particularly selling low when you know that they bought high. But those deals are out there, they exist. If you've got access to capital when you come across those and you can snatch them up, it doesn't take a lot of those to get your portfolio, your investment portfolio healthy really, really fast.
Would you also add to that there's the possibility of this large transfer of wealth? They're estimating somewhere in the $71 trillion amount range being left through inheritance from baby boomers that obviously over the next decade and a half or 2 decades are going to be passing along to the millennials. And what would you recommend? Well, let's say we're talking to somebody in their 20s and 30s right now who stands to inherit money at some point in life, or comes across a windfall of capital, or happens to tap into a pre-existing equity position in the form of a debt weapon like a home equity line of credit. Is it, in your opinion, a better time right now to sit on that and wait to see what happens, or to simply take action with that money immediately and start putting it into the market the way it is today?
Yeah, I mean, I'm sure a lot of people watching now, that maybe were or were not involved in real estate investing after the last crash, back in '08, that wish they would have been active in the market in the years following that. I mean, there was generational wealth that was achieved in those, that handful of years. The same thing could be right around the corner. So if you do have, cash reserves, if you do have a war chest, is there going to be blood in the streets? We don't know for absolute certain, but if there is, and like we talk about, always best to be prepared just in case it does happen that way. There's going to be an abundance of deals out there that are going to be available to you.
Yeah, and I completely agree with you. I think I wasn't clear about the question. I'm asking if somebody has access to that war chest you're talking about today, are you suggesting that they go out today and buy a property, or are you saying it's better to wait and see what happens with the market so that you can get a better deal?
I mean, I think that right now would not necessarily be the right time. I think over the next 30 to 60 days, we're going to see a little bit more of the tea leaves. We're going to see, I think, some panic selling is going to start. Sellers that were maybe on the fence and they thought that maybe the market was potentially going to continue to go higher. They're seeing it start to stall out right now. So I think that, there are going to be some price reductions. So it just depends on the motivation of the buyer. As an investor, I'm going to be out there active. I'm active now. I'm going to be more and more active once I start seeing kind of how the market's responding to some of the things the Fed's doing, seeing what's going on in the real estate market as far as really supply and demand, and all of those things are going to guide my actions. I'm going to utilize that data to make my decisions.
Exactly. So you're just watching the data, and obviously, let's say that your entire access to capital is a pie, right? What percentage of your access to capital would you say you're allocating into the market the way it is today versus what you're setting aside as your future investment according to potential dips where you can get things for a better price?
Yeah, so off the top of my head, I don't have that percentage, and I work with a lot of investor groups as well, and we're always, kind of adding to that pie. So it's really constantly getting bigger. So what that number means to me today, 30 days from now, it's probably going to be a little bit different. But I'd say a good rule of thumb. I mean, I always want to have about 25% of my available capital in play. I keep that rested in case I do come across, or when I do come across those good deals, so that I can spring on them. So I do like to have a war chest that I've got access to. I don't have to liquidate anything, but I also like to have obviously those longer term plays where that money is tied up. So a combination of both.
Got it. So it's really just a matter of focusing on the data, but leaving yourself the ability to take action for future deals should the market continue to adjust. Don't go out and exhaust all of your availability. Certainly wouldn't make any sense at all to not have anything left to fuel your ability to invest. And if you're going to buy something now, the messaging I think that's best to take away from this is it better be a performing deal as is. There needs to be enough cash flow that the actual value of the property really doesn't make that much difference at all. I think if you don't have any plans to sell, what it's worth matters less than if your intention was to keep it for a shorter period of time. Of course, it affects your down payment, and that obviously minimizes your ability to stay active elsewhere. Costs of closing are slightly higher. Obviously, your cash flow is reduced because you obviously are taking on more leverage if you are financing. However, it would have to be all about cash flow in that situation to make some of these deals worth it that we just explored in some of these geographical areas. So making sure that you're focusing on cash flow as always is going to be the biggest takeaway, of course. But furthermore, making sure that you're rationing out so you don't gas out when the best deals come around.
Yeah, and you and I both love the short-term rental space, and what we love most about investing in it, particularly if it's already performing, just like you said, we're walking into a performing asset at that point. We've already got bookings on the books for months at a time going into those deals. So you are in most cases walking into obviously cash flow positive. So looking at those deals, those are existing out there right now. We're doing a lot of them obviously in Orlando, and which has been historically one of the hottest markets, particularly over the last couple of years here. And we're getting into those houses even when it was at the top of the market. The math still made sense because again they had that positive cash flow position.
Great. Well, I appreciate you being on today, Michael. Look forward to having you back on the channel again soon, and we'll keep tracking this market for everybody here watching. Make sure you subscribe Drop a like on this video if you don't mind. It certainly helps us out a lot. And guys, until we see you on the next one, make it a great day and keep on cash flowing. Take care.